Right, good. Well, look, I think I'm seeing a good number of people joining us now. So let's begin the webinar for real, and I'll do a little formal introduction. So a reminder, my name is Andrew Barclay, and I'll give you a brief career update. What's happened to me so far, and we have to go way back to 1991 when I graduated with a degree in, wait for it, English literature. And those of you thinking, wow, we've got somebody who's lived and breathed finance all their life. I'm sorry to disappoint right from the get-go. 1991, not a good year to graduate. Actually, jobs were thin on the ground, and I joined the railways, what was then British Rail, and found myself, much to my surprise, heavily involved in rail privatization during the 1990s, and that led to me in 1996, deciding that actually I wanted to up my skills. And that's when I decided that finance was a good option to investigate. And I joined KPMG as a trainee auditor and went through a process a lot of people have gone through, qualifying as a chartered accountant in 1999. So taking 3 years, got the exams under my belt, and then joined KPMG Corporate Finance. And at the time, KPMG Corporate Finance was heavily involved in PFI PPP projects in the UK, which meant that I joined a team building and reviewing models that were supporting these deals. And that was my first introduction, I suppose, to financial modeling. And I remember as a relatively junior analyst being fascinated and frustrated at the same time at the fact that some financial models were easy to work with, easy to manipulate, easy to navigate, and others were very, very difficult. And that got me very interested in financial modeling as a discipline, and particularly the difference between good financial models and bad financial models. And that interest never really left me. So I continued with KPMG Corporate Finance, and left them in 2004 because I decided that teaching was something that I wanted to pursue a little more full time. And so I left, set up as a freelance accountancy tutor. I did a lot of work with an American training firm called Kaplan. I ran a short financial modeling course with Kaplan. I also worked for the Association of Corporate Treasurers. And then in about 2011, 2012, I started a conversation with F1F9. And F1F9 I knew were niche providers of financial modeling training. I'd come across them at KPMG and discovered that I had a connection with one of the directors there. And that conversation led to me running all of F1F9's training courses around the world for about the next 2 or 3 years. And that was a process that I thoroughly enjoyed. And so with some degree of surprise, I find now that I've been full-time as a director with F1F9 for about 10 years. So that's a little bit of a background about me. I'll talk in just a second about our objectives for the webinar today. But Arup, do you want to give a brief introduction to yourself as well? That'd be great to hear from you.
Thank you, Andrew. Hello, everyone. My name is Arup Das, and I am a manager at F1F9. I've been working for F1F9 for more than 7 years now, ever since I joined its India office fresh out of college. So not much work ex before I joined F1F9. But since I joined F1F9, I have worked on various projects which are spread across various sectors like infrastructure, oil and gas, and power. Currently, my major focus is on the training side of the business. So I look after the online training and the public courses that we deliver from time to time. That's about it, Andrew. Over to you.
Perfect. Thank you, Arup. And Arup is here really to, well, partly to make sure that if things go wrong, he can step in seamlessly and carry on the webinar without me. So I think it was important to introduce him. But also, this is a demonstration of how we run training courses online when we do live online courses, and indeed in the classroom. We'll always have 2 of us working with you to keep the energy going, to keep the class dynamic going. So with that little bit of background, let me talk a little bit about my objectives over the next 40 to 45 minutes, which is I want to run a session a training session, in effect, which is illustrative of the sort of training that we run at F1, F9. This particular topic, foreign exchange, is one that I would class as an advanced topic, and it's one that we don't normally offer in our standard courses. So in that sense, in this webinar, you're seeing something that is a little bit unusual. Although having said that, with our in-house clients, we have run this on a number of occasions where they have a particular interest in foreign exchange. And the assumption I'm going to make is that if you've taken the time to join this webinar, then you've got an interest in modeling foreign exchange, and so I'm going to take as read the fact that this is a topic that you're interested in. And so we'll spend about 45 minutes with me running the session as if this were part of a live online training course. At the end of the session, I'm going to ask Arup to review the Q&A part of Zoom. And so let me say at this stage that by all means, seek out the Q&A side of Zoom. And if you want to type in a test question or something, just to get yourself comfortable with using it, then that's fine. What Arup will do is towards the end of the session, he'll take a look at those questions and we'll see how many we can answer as we go through. And therefore, I'm not proposing to break off and answer questions as we go through, unless Arup interrupts me and says, Andrew, there's such a good question here. I'm going to disturb all your carefully laid plans and ask you to answer it straight away. Good. So Arup, let me confirm, you can all see my screen, and I'm hoping you're seeing something that says 6 steps to foreign exchange happiness.
Yes, Andrew, I can.
Perfect. All right. So in terms of technical delivery, technical content, my objective over this session is to open up a financial model, and we have got a task which is to convert a local currency loan into a foreign currency loan. And in this particular model, as we're going to see in a second, the local currency I've actually called local. I've actually given it a 3-letter acronym, LCY, which I'm going to refer to as a Lucy. To the best of my knowledge, it is a fictional currency, but currencies do have 3-letter acronyms. They all do. This is one of the instances where the world has agreed on a single way of doing things, 3-letter acronyms for currencies. And so to the best of my knowledge, LCY, a Lucy, is a fictional currency. But no matter. And we've got a model whereby we have got a loan expressed in Lucies. And what we want to do is to convert that loan into euros. And therefore, we are financing a project that is generating revenues and costs in Lucies, but is being financed by a debt in euros. Now, there would be various reasons why you might want to access foreign debt markets to support a local currency project. And at this stage, I need to be a little bit careful and just remind myself, Andrew, that this is a modeling seminar. And so I'm going to resist getting into too much of the reasons why you might do that. I suppose let me throw one in, which is that the project is more confident of getting a better price by going to a foreign currency market than it would be by going to a local market. So that's our objective, to take a model with a local currency loan and convert it into a foreign currency loan. And then I've put a second objective, which is that we want to amend the financial model in such a way that we're able to test the project's sensitivity to changes in foreign exchange rates. And what I'm thinking here is, let's imagine that in my local currency, revenues and costs, and therefore cash flow arising available for debt service. Let's imagine that is going to be as we forecast. But what if the debt becomes more expensive to repay? What if the interest becomes more expensive to repay because of moving exchange rates? At what point does the project become unsustainable? And that's my priority here in terms of what I'm interested in finding out, what I'm interested in testing in the model. And I've expressed that in a second way down here, because it's it can be a little bit tricky to get across as as a concept. So in other words, how much would exchange rates have to move before the project generates insufficient cash flows to service the debt? And this is a concern that we come across with a lot of clients that we work with. It's one of the primary reasons why you would want to forecast a project, look at the financing of the project. This risk is one that tends to rank quite high as a risk. Now, at which point I should admit a bit of a confession here, which is that from a personal point of view, my brain does not deal well with foreign exchange. And I've no idea why. It's probably something to do with the English literature background. But when I look at an exchange rate, it's not obvious to me what that exchange rate is telling me. And therefore, I have to stop and think it through. And one of the reasons why I want to teach this session is because it seems to me that one of the arts of teaching is to be able to make a complex topic a little simpler by breaking it down into its constituent parts. And this is something I'm going to confess to you that I have to do almost every single time, is to get that logic flow clear so that I know what I'm following. And my logic is that if I can understand it, then I think there's a good chance that you, who I'm expecting have got brains that are perhaps a little bit better attuned to foreign exchange quotations and how they work, you'll be able to pick that up a little bit easier. But even without my own personal failings, it's worth noting from a modeling point of view that foreign exchange calls upon three major disciplines. It calls upon accounting knowledge, it calls upon treasury knowledge, and it calls upon modeling knowledge. And you need to know a little bit about all three in order to be able to cope with this topic. And that again is one of the things that I find from experience. It causes people not to be perhaps as confident about this topic as they would be about some others. And the way I found to teach this is by going through what I consistently describe as 6 steps to foreign exchange happiness. And I should say, I suppose, foreign exchange modeling happiness. I'm not sure this is going to help if you are, I don't know, trading or spread betting or something like that. So let's amend, let's put a little bit of a disclaimer in there. 6 steps to foreign exchange modeling happiness. And I have given you those 6 steps just as a list here. This is what I'm proposing to go through in this session. The 6 steps being, first of all, choosing a quotation convention. Secondly, identifying the currency types that exist in your project. Thirdly, and this is very much a modeling issue, deciding when flows happen. And that could be cash flows, but that also could be flows going through the income statement. And then we're into the actual executive action, if you like. So we're going to convert balances, we're going to convert flows, and then finally, step 6 is to calculate a gain or loss. And once that gain or loss is calculated and put into the model, we are hoping, our aim is to get everything balancing. And also for us, as I say, if I look at my first off objective is to be able to run sensitivities and begin to say, well, at what point does do the cash flows, do we really feel the strain with the model? And so before I get into those 6 steps, I think I should also tell you a little bit about what's in the model that I'm showing you here. And in order to avoid a whole host of questions that we would otherwise get, let me say at the outset, we plan to share this model with you. So please don't think that you're going to see this and then we're going to take it away from you. If you're interested, then by all means, we will share the model with you. And what I have done with this model is I've attempted to strip it right back so that we can focus on foreign exchange issues. And for those of you that have not come across the style in which F1, F9 models, I don't propose to go through that right now. I'll mention a couple of resources for you to take a look at if you want to get a little more familiar with the way that F1, F9 models. But what I will do is go to a financial statement sheet and take a look at my cash flow statement. And the first thing you might notice, and I think, Arup, this is worth me saying, I'm not going to say much about our basics, but the first thing you may well notice is that we've got horrible yellow color all over the place. And let me just reassure you, that yellow color there is deliberate, because what that tells me, and more important, what that tells Arup, is that this is a part of the model where we've done something, but we have yet to finish it. And so you can see, for example, because I wasn't going to talk directly about working capital, you can see that I've got hard-coded numbers. I've just put those in there, but marked that in yellow just in case you were to think, well, why on earth have they modeled working capital just as a hard-coded number? And likewise, other items, capital expenditure and tax, you can see that we've got nothing in here at all. The relationship that I'm interested in, though, is what we've got down here. Is row 40. I've got a cash flow available for a revolving credit facility. Now, we needn't worry about the revolving credit facility. What I would like us to note is that this cash flow is stated after we have serviced the debt. And so what I'm interested in here is, how much robustness is there in that cash flow, such that if we do have increases in my interest, increases in my principal repayment, what problems might that cause me? And if I just chart those cash flows, you can see here that to begin with, we've got a bit of tightness going on. We've got a bit of, something to worry about here. And then cash flows, they gradually get better over time. And then suddenly they look significantly better. Now, if I were to look at a model, my immediate assumption would be that where cash flows suddenly look significantly better, that's normally when the debt has been repaid. Okay, and so I'm just getting a sense here of a model which is saying we've got debt over this period. What's that? Over 17 columns, and that's where I'm going to be worrying about: am I generating sufficient cash in order to repay that debt? And I can see it starts off a little bit tight, gradually gets better over time, but that is what I'm going to be interested in. What I want to review, and what I want to be able to test by saying, well, if exchange rates do go up, let's see what the impact is. And if I look at my rows above, you can see that we have got a calculation of, I've got some senior debt, interest expense and paid, senior debt, principal repayment. Those of you who have come across F1, F9 modeling before will know that we are great advocates of links. And our reason for advocating links in models is because they allow you to navigate easily through the model. So I've just hopped back on that link to its source. And I think it's worth me saying at this stage that if you do want to find out more about our approach to modeling, then I recommend 2 free courses on our resources page, one called Excel Proficiency Skills and another called Model Construction Skills, freely available on our website for you to take a look at the approach that we're going to be taking. So if you've never come across this before, if this is looking a little alien to you, then rest assured there are resources that we offer on our website to keep your interest going, to keep you engaged with that. So I can see I'm now on a senior debt sheet, and I can see I've got a calculation of senior debt interest. I've got a calculation of senior debt principal. You can also see there's a fair amount of yellow going on around the place, a nasty yellow color, which suggests that there is still things to be done in the model. And then I've got a senior debt balance down the bottom here as well. And it's probably also worth me saying from an accounting point of view that I am expecting my senior debt interest expense and paid, I'm going to take that off to my income statement and my cash flow statement. The principal repayment is going to go to my cash flow statement only, and the balance, the clue is in the name, I'm going to take that off to my balance sheet. And so you can see this sheet laid out from an accounting logic point of view, giving you some indication as to where these calculations are going to go. So let's move back to my 6 steps to foreign exchange happiness and begin to work through these. So the first one I wanted to talk about is choosing a quotation convention. And I put this in the various messages that we sent out promoting this webinar. I threw out a question, which is, for example, what does GBP USD 1.21, what does that actually mean? And I speak from a little bit of experience here in feeling a certain amount of pain when I see somebody writing that. And the reason why I feel that pain is because I've taken 2 sets of professional exams. I took chartered accountancy exams and I also took treasury exams. Now, when I took my chartered accountancy exams, what I was taught was that GBP to USD, just on its own, without the number there, meant that you took a variable number of pounds divided by a number of US dollars to give you a rate per $1 US. In other words, what I was taught with my accountancy qualification was that you had the variable currency on the top and you had the base currency on the bottom. So then imagine my delight. And for those of you wondering, I'm being deeply ironic here. Imagine my delight when I then decided to expand my professional knowledge and take treasury exams to discover that treasurers look at it the other way around. They say base currency on the left, variable currency on the right. Having worked with both, my personal preference, without question, is you work with the Treasury Convention. If you Google GBP stroke USD, for example, and see what it comes up with, it will make that assumption. Base currency on the left, variable currency on the right. I don't mind which you do with your models as long as you are consistent. And we are going to use, or as I do my modeling with you, that is the convention that I'm going to use here. I'm going to assume that we have got base currency on the left, variable currency on the right, which means that 1.21. So a 1.21 expressed with that convention means that we are looking at a variable number of US dollars per £1. Or in my model, because I was working with a fictional currency, I'm going to be working with a fictional currency. And so let me tell you what rate we are going to be starting with. We are going to be looking at already I've got that the wrong way around. We're going to be looking at a number of luces per €1. We are going to be assuming 3. So at a particular date, and I'm going to talk about this in a little more detail, at a particular date in time, we are going to assume that we have got 3 luces for €1. So choosing a quotation convention, that is the first of our 6 steps. Now, the second step, if this step is to do with following what treasurers do, the second step, identifying currency types, is very much to do with accounting. And what do I mean about identifying currency types? Well, you have got a number of currency types to worry about. Let me talk about the first of those. The first of those, I'm going to talk about transactional currencies. And the point about transactional currencies is that a project can have lots of them. So if I think about F1, F9, for example, to give you an example, we invoice in pound sterling. We also invoice in US dollars, Arabic dirhams, and euros. So straight off, just looking at revenue, we have got 4 transactional currencies. We've also got a cost base that is in Indian rupees, and go back a few years, we had a cost base in Canadian dollars as well. So potentially lots of transactional currencies. And you, with your project, the first thing you need to do when thinking about foreign exchange is to identify how many transactional currencies you're working with. Now, in our project, I'm going to keep things simple. We have got 2. We have got luces, which everything is in except for the debt that we are proposing to put in euros. The second type of currency I need to worry about is what I'm going to call a functional currency. And this is using the language of IAS 21, International Accounting Standard 21, which identifies a functional currency. And here's the thing about a functional currency: you can choose only one. So I'm going to put only one there. Now, you can choose whatever currency you like. You could have a project with Lucy's in euros and decide you want the functional currency to be Danish kroner. Not a lot of point in doing that, because all you're doing is establishing an awful lot of work for you to do as a modeler. And so what models tend to do is they reduce the amount of work that they need to do. They choose a functional currency and they choose the one that is going to require the least work. Well, the one that requires the least work is the one which represents the majority of the transactions. Majority of my transactions I know are in Lucy's, and therefore I'm going to effectively build the model such that everything is converted into Lucy's. I'm going to build the model with a local currency. The final currency type you need to be aware of is a presentational currency. And this is to do with when you are saying, well, I've now got a set of results and I want to show those results from an accounting point of view. I want to present a set of results. Again, lots of presentational currencies are possible. You could choose Danish kroner, you could choose US dollar, you could choose whatever. From my point of view, because I am only really interested in cash flow impact, and I'm not interested in seeing the accounting impact of my foreign exchange transactions, I am going to run with local currency as my presentational currency, which means that I have nothing to do to get from functional to local currency. The final thing I want to say on this is, if you were to choose a presentational currency of, let's say, euros, there is no guarantee that the euro number that you see in your transactional currency is going to match the same number when you present the results. And that's because the accounting rules to get you from transactional to functional, and then from functional to presentational, they're not the same. And this requires a detailed reading of IAS 21. But that's worth noting. You wouldn't necessarily expect to see the same answers. What you can't do, though, is somehow bypass going through that functional currency. That functional currency is absolutely essential. Now, next, step 3, and this is the final conceptual step. Once we've done that, we are then into the modeling. We're then into looking at actually getting some modeling put together. So deciding when flows happen. Now, this causes a lot of debate, because what the modeler desires is accuracy of cash flows. And, you know, I get that as a modeler. I want the model to be as accurate as I can. The advice I would give at this stage is, if we're looking at the impact on cash flows, as far as possible, run with end of period cash flows. And this is something that we would recommend generally for forecast modeling. Normally, because the additional accuracy you would get by trying to go mid-flow or average flows or whatever, it tends not to be worth the extra pain and the extra effort to achieve it. Now, of course, there are exceptions to that, but I think if I were modeling, say, senior debt, which I'm going to be looking at with this model, then I think end of period cash flows is a safe assumption. And certainly with a lot of models that we build that are reviewed by lenders, that are used by lenders, end of period cash flows tends to be accepted as a good standard to work with. If you think there is a case for going into more detail, you then just need to decide, have I got sufficient do I get sufficient additional accuracy from my model in order to justify what will be a significant amount of extra work? Okay, so I'm going to run with a decision that flows happen at the end of the period. So step 4, converting the balance. We're back into accounting standards here. And the accounting standards are very clear when it comes to converting balances. What the accounting standard says is you should use what's called a closing rate. In other words, the exchange rate that applies at the balance sheet date. And so if I now head off to my model and take a look at my senior debt sheet and have a look at my balance, what I'm going to be interested in doing is to say, well, let's identify a balance at each period, and what we're going to do is to apply a rate that is in effect at each of these dates. You can see 30th of September, 31st of March, what have you. And we'll take a look at some of those rates in just a second. But before I even get into that, I've got a bit of a mixed message that I'm giving in my model at the moment. So let me demonstrate. For example, I can see that I've got a senior debt balance here with euros coming in as a currency, but I can also see that we have got a principal repayments appearing in the local currency. So there's clearly some sort of mix-up going on here, which I want to try and resolve before we go any further. So the first thing I'm going to do is I'm going to make it very clear that we're going to calculate the senior debt balance in the transactional currency. I'm going to start by calculating it in euros, and I'm going to put that in every single label. So let's just set that up there. I've now got this set up so that we can see a euro senior debt balance, and therefore it would be quite odd to see local currencies applying through here. So I can see that this is really not what I want at the moment. So let's delete that. We're going to mark that yellow. In fact, mark the whole thing yellow. In fact, you know what, I'm just going to remove the whole thing and say, well, what we want in here instead is going to be my euro senior debt principal repayment. And what I'm going to do is then say, we're going to take the senior debt balance expressed in euros, and I am going to convert that into a local currency equivalent. And what I've said is that we're going to do that at the prevailing closing rate at the balance sheet dates. Now, those closing rates, I have set something pretty rough and ready up on the timesheet. And I'm just going to chart it for you. Row 73, let's chart this, these rates. And what you can see is that you have got rates which are increasing over time and then peaking and then coming back down again. Now, the way that I have forecast those exchange rates is by using a piece of economic theory called the four-way equivalence model. And the four-way equivalence model in particular, something called purchasing power parity theory. Now, again, I need to curb my enthusiasm, remind myself that this is a modeling course and not an economics course. All I'm going to say is that this theory assumes that exchange rates, inflation, and interest rates are all interlinked. And so I've got a little rough and ready calculation for you to take away and take a look at. But the important thing is that it gives me a forecast of my exchange rates that is going to change over time, and therefore gives me some rates that are going to apply at the closing date. Now, having said that, when I talk to clients, certainly some of the larger clients will tell me, well, if I want to get some exchange rates, then I simply ring somebody up and they provide me with a forecast over the next X years, and that's what I use. Anyway, I leave it up to you which you want to run with. We are going to link through my exchange rates. I'm going to go back to my senior debt sheet. We're going to link through that exchange rate to allow me to calculate a senior debt balance that is now going to be expressed in my local currency. And already it's happened. My my brain is thinking, well, what do I do here? Do I multiply or do I divide? And here is the way I'm going to, again, confession time, English literature brain. This is what it does. It says, well, if I've got 3 local currency for €1 and I'm starting with euros, then I must end up with a bigger number than what I started with. I'm expecting this number down here to be 3 times what I've got up here. And let me, Arup has got much more of an engineer's brain, much more of a mathematician's brain. Arup, is that logic correct, would you say?
Yes, Andrew, that's perfect.
Thank you. Thank you. Great relief for that confirmation. Thank you very much. So we're just going to multiply the 2 together and shoot that across. There we are. Okay. So I could now see my senior debt balance converted, and that's been converted at the closing rate that applies at the end of each period. At each balance sheet date, I've now got a conversion. And you can see already, I hope, how the debt is getting more expensive. I started off owing 1.44 million, but 6 months later, I'm now owing 1.46. You can see that with a balance that isn't changing at all. It's that the euro balance is sat at 480,000, but those euros are just getting a little bit more expensive. Well, a little bit more expensive. They're getting more expensive. Right, good. That's converting the balance. Now, converting the flows. First of all, let's get those flows modeled. And the flow that I am interested in is my principal repayments. If we've got time, we'll take a look at interest. But to be honest with you, once we've been through this process once, I think you'll see how to work with the interest. But in terms of converting flows, it's principal repayment. So let me now take a look and see what we have got for my principal repayment. What I've got up here is a scenario selector that allows me to choose between different debt scenarios. I've got that set up. That's being driven off an index function. Again, the index function, most useful function, a very useful function, one that we use a lot in our courses. Highly recommend it for this sort of simple scenario selection. I am driving the model at the moment of 7.5-year debt, but you can play around with that scenario, put it to 2 and you'll get 10 years, 3, 15 years, etc. Okay, and what I'm doing is then saying, well, that's giving me a number of percentages that are adding up to 100%. And then what I've got down here is a senior debt principal repayment expressed in local currency. Well, what I want to do is to express that instead in euros. So again, let's go through senior debt balance at acquisition date. I'm going to make that my euro senior debt balance at acquisition date. That at the moment is expressed in local currency. The assumption I'm going to make, as I mentioned earlier, is that we have 3 looses for every €1. And so again, I'm looking at a route here. I'm going to do a little rough and ready calculation. If I want to convert my looses into euros, I'm going to divide by 3. Looking up with hope at a route, getting a nice nod from India there. That's excellent. And we're going to make sure that the units are now in euros. And so all I'm simply saying now is that if I take my percentages and multiply by that balance, I've now got my senior debt principal repayment, and that is expressed in euros. Let's get that set up there.
Andrew, if I may interrupt.
Please do.
Andrew, looking at row 38, it looks like the euro balance is 480,000.
Yeah.
So in row 30, I think it should be 480,000 only euros.
Well, so one of these numbers is wrong, isn't it? And again, this is the great advantage of working temporarily. So I've communicated to Arup. He's spotted something that doesn't look right. My defense, is yellow, Arup. I'm still working on it, but you know, nothing's linked through here. But you're absolutely right. I need a balance that's going to be adjusted by 3 down here as well. And again, for avoidance of doubts, this is not the finished look. We would never leave a model like this. This is indicating, you know, something that I've got in place temporarily. One of the advantages of that, of course, is I can then hand it over to somebody else and say, can you just sort out my placeholders for me? A very important principle of team-based modeling there. But Arup, are you now happy with that? Perfect. All right, good. Well, what I would like to do now is we are going to take our flows and we're also going to convert those. So I'm going to take those flows and we're going to convert those. So go back to what I said about the timing of the flows. If we are assuming end of period flows for my cash flows, then they are going to happen at the same time that the balance sheet is put together. And that's on the assumption, of course, that you've set up your model such that end of periods coincide with when you're putting balance sheets together. I can't think why you wouldn't do that, but that's certainly the assumption that we're making, which means that it is perfectly reasonable for me to apply a closing rate to my flows. Certainly my cash flows, and certainly if you're looking at senior debt, that makes perfect sense, where again, you would want the model to be aligned with when you are going to repay the senior debt. And therefore, you know, we've got a nice consistency, a nice alignment in my model. Now, with that assumption in place, all I need to do now is take a copy of this conversion block that we put together previously, and I am going to insert that just above my senior debt balance. Now, let's just see where my euro senior debt principal repayment. Okay, that is going somewhere. We'll worry about that in a little while. Let's just mark that in red to say I want to investigate, see where that is going. We may need to remove that. And let me link through to my principal repayment. So I'm going to link through up here. And what I've now got is my senior debt principal repayments. Again, same approach. And I'm going to give that a row total here to see how much we are repaying in principal. Now, let's just go back to Arup's 480,000, because that said we had a debt amount before we divided by 3. So 480,000 gave us 160,000 in euros, but in the local currency, that debt was expressed as 480,000. If I'm now repaying 554,000, then that debt has evidently got more expensive. And therefore, I'm beginning to think, well, what I need to incorporate in my model is not a gain, is not a foreign exchange gain, but a foreign exchange loss. I'm losing by the fact that I am losing by the fact that the debt is becoming more expensive. Now, what I'm also going to do is just a little bit of housekeeping here to do with management of negative numbers. I'm not going to go through with you in detail the management of negative numbers. That is something, again, that you'll find on our courses. But let me just put something in place that is going to be helpful, I hope, as we finish off as we come towards the end of the webinar. I'm hoping now that is giving me my senior debt principal repayment expressed in my local currency, expressed in the functional currency. Now I'm seeing that 554,581. So we've now got 2 of our items done. We now have got a view on what the principal repayment is going to be in local currency after taking the foreign exchange into account, the foreign exchange movements into account, and we've got the balance as well. And if I go back to my 6 steps, we've now moved through 5 of those 6 steps. And I'm now looking at my timing. I was hoping to take Q&A at 10:02. I'm running a tiny bit behind here. But you may be thinking, well, how hard can the gain or loss be? And the answer is that conceptually, it's a little bit tough. So let me see if I can just spend the next 3 minutes completing step 6 so that you've got an idea of the gain or loss. And then I think we can probably open up and take a look at some questions. So I'm going to set up a new section here where we're going to look at Forex gain or loss. And this is going to end up going through to the income statement, because what we're saying is we need to recognize the impact on profits of the debt becoming more expensive. And what I think it's worth realizing is that the gain or loss arises because of the balance. And in that, if we had no balance to worry about, in other words, if we were putting through the income statement and putting through the cash flow identical items at the same time, then we're not going to worry about any gain or loss arising. And if I look at my balance is made up of 3 items. My closing balance is made up of 3 items. I've got a beginning balance plus something that causes the balance to go up, less something that causes the balance to go down. And I think I should probably link this through to what I've just calculated. Otherwise, you're going to see a balance that is just remaining the same. So let me just tidy that up there a little bit. I don't think we need that pos suffix there. Let's introduce this to my balance sheet item and see that coming through. Good. So we've now got a senior debt balance that is going down. There's my euro senior debt balance going down. So any gains or losses will arise from these 3 items that make up the balance. Now, one of these we can immediately ignore: drawdowns. I don't have any drawdowns in my model, and therefore, for now and for the purposes of this webinar, I can say we can ignore that. It's not going to have any influence on the calculation of a gain or loss. The principal repayment we can also ignore. Why? Because I am making the simplifying assumption that balances and flows happen at the same time. And therefore, I'm going to use the same rate to convert the balance as I am going to convert the flow. And therefore, any gain or loss that might arise from the relationship between the balance and the flow, we can ignore. Let me be very clear. If you decide to convert flows using an average rate or some other rate that is different from the balance, then you have a lot of modeling to do to reconcile the two and to understand the gain or loss that arises. But with this assumption, which in the vast majority of models I come across is perfectly acceptable, assuming that both are happening at the same time, simplifies our modeling without losing too much accuracy with what we want to do with the model. So the only thing I need to worry about is the 3rd element of my balance, which is my beginning balance. And that's what I'm going to link to begin with when I'm going to think about a gain or loss. Link to my beginning balance. I'm then going to bring in my closing spot exchange rate. Again, it's a balance, and therefore I am looking at converting it at a closing spot exchange rate. And I'm going to do 2 calculations. I'm going to calculate my senior debt balance beginning using the current period exchange rate. And I'm also going to calculate my senior debt balance beginning using the previous period rate. And a comparison of the two is going to give me the difference, the contribution to a gain or loss arising from that beginning balance. Both of these are going to be in Lucy's. And therefore, if I'm going to calculate my current period rate, I want the balance multiplied by the current period. Copy that across. Looking across at Arup, make sure he looks pretty happy with what I've done there. Good reassuring nods. Thank you for that, Arup. Now, let's put together the previous period rate. That's going to be the beginning balance multiplied by the previous rate. And you'll notice that I am going into column I here. I'm going back one from the timeline there. And I'm just indicating that I'm doing a one period look back there, pointing to column I, marking that in gray. You'll notice we do the same up here, where we are using effectively an empty cell. Right, shoot that across and let's see what that gives me. Now, what's interesting about this is that in this very first column, you can see the impact that this has had. So at the start of the period, as at the 31st of March, 2021, the end of the period, we owed 480,000. 6 months later, we owe 486,000. That sounds to me like a foreign exchange loss. And therefore, when I calculate my Forex gain or loss, I want to come up with a calculation whereby a positive number appears as a gain and a negative number appears as a loss. And I'm going to do that very simply by saying, well, we'll take the previous minus the current. Let's just check that first period. See if we can get in that. And we can see, you know, we are incurring a loss as we go through. Now let's put a row total in for that loss. 74,581. Now, my heart is beating at this point, as it does every time I run this in a course, because what I want to do is to make sure, is that the difference between what I was expecting to repay, which was my 480,000, and what I'm actually repaying. So I'm just going to do a little trivial calculation here, just to reassure myself that if I remove 480,000, I do indeed get 74,581. So I've now got some degree of reassurance. I'm showing a loss of 74,581, some degree of reassurance that that looks to be the right sort of number. Now, let's finish off by going to my financial statement sheet and just seeing what we have got here. I'm going to do a full recalculation of the model, and I'm expecting the model to break as a result, but let's just see what happens if I now do a full recalc. Okay, so I've got an error check. Let's take a look at that error check. I've got a balance sheet difference appearing, and I'm looking at this and thinking, yeah, okay, there is certainly a balance sheet difference going on. Not sure what's going on here. My suspicion is it's to do with the debt, because we started this webinar with the debt intact in place. We have now played around with it. And so therefore, I'm going to look at these debt balances and see what I need to do to restore them. You'll notice that this says euros, an immediate clue to you that we're pointing to the wrong thing. Senior debt principal repayment, that's in Lucy's there. The interest up above is still in euros, but we'll worry about that in just a second. I'm going to take a look and see if I can restore my balance sheet here. So I don't want my euro senior debt balance. I want the senior debt balance in Lucy's. So let's take that and we're going to link that through. Likewise, in my cash flow, the principal repayment that appears to be loose is there's my 554581. That looks relatively safe. My foreign exchange gain or loss up the top here. Let's link that through as well. Back to my senior debt sheet, into my gain or loss, and we can shoot that across too. Right, now the color management you can see going on here, this is very much part of the house style conventions that we use. And I'm now back in a position whereby my model appears to be green, appears to be balancing. All things are well. You'll notice that my senior debt interest expense and paid is still showing euros. What I am tempted to do with that, I could do one of two things. I could model it now simply by taking a copy of what we've done down below, or I could say, do you know what, we've got 3 minutes to go before the end of the webinar. I'm acutely aware I've not taken any questions, so I'm going to use an old trick, which is just to remove the interest from both the cash flow and the income statement. Done that, full recalculation, and we will we'll model that, get that modeled, and before we send things out. The final thing I will say to you before we open up, and I'm going to ask Arup for any questions, is we've also included in this model a check sheet and a track sheet. The track sheet being a most useful way of being able to track the differences that you've made in your model to previous versions of the model that you have stored. And so I'm going to put that in place. By all means, go through, take a look at that, and you can see what I've introduced, see the impact on the model of introducing that foreign currency debt. That is all I wanted to say on the final stage, calculating the gain or loss, using that beginning balance to simplify, assuming those end of period flows and balance converted at the same rate as the balance sheet date. Arup, over to you. What questions do we have that I might be able to answer in the next 1 minute?
Andrew, we have this interesting one. Ibrahim has asked, how do we factor in effect of differential inflation rate at the different currency locations?
Well, if you've got multiple currencies, the key thing is putting them all through the same functional currency. So with this model, we've only had one conversion to do, but if I were modeling F1, F9, I would have revenues in dirhams, I would have costs in rupees, and I would want to put those all into sterling. And so the modeling I've shown you would need to be repeated for every transactional currency that you're looking at. So there's nothing, if I've understood the question correctly, there's nothing new. It's just you've got to repeat what I've shown you for one currency to do that multiple times. Any other questions?
No more questions, Andrew, but maybe we can give them 1 minute to type. So guys, you can type your question in the Q&A if you have any. We will answer them.
Perfect. Good. Okay. Well, while we're waiting for that, let me just wrap up. Let me just do a quick summary. 6 steps to foreign exchange happiness. I suppose the thing that I didn't talk about at the end, but I'm going to leave you to play with, is the sensitivity. You know, the whole point of the objective was now to say, let's flex the model. And what I've done is I have got, again, in that yellow there, I've got a sensitivity allowing you to put in a 10% sensitivity on exchange rates. And if I now go back to my track sheet, you can see, my foreign exchange gain or loss has now gone up to 130,000. And if we go back to my cash flow statement, you can then go through and take a look to see whether we go negative. Now, of course, as I've just stripped out senior debt interest, things have got a lot rosier, so we need to put the interest back in, which we'll do before we send the model out. We'll have the local currency interest in there, but you can play around with that sensitivity and see the impact on the model's cash flows. Arup, any other questions?
Yes, Andrew, we have got a few. So let me read that out. So are all balance sheet items translated the same way if they are in foreign currency? What about fixed assets and share capital?
Okay, so that's a very good point, and that's where you are getting into accounting standards. And again, I don't want to go too much into that, except to say that what you need to look out for is a distinction between what are called monetary assets and non-monetary assets. A fixed asset is an example of a non-monetary asset, which should be converted using a historic rate. Whereas monetary assets would be receivables, payables, debt. There you're looking at a closing rate. So that's very much an accounting question, and one that's worth reading IAS 21 quite closely to get the distinction there. What else have we got, Arup?
Okay, Andrew, let's pick up one final question. This is from Hugh. He says, you have mentioned a more complex calculation when cash flows and balance forex rates differ. What additional work would be involved for the reconciliation?
Okay, I'm going to give a really unhelpful answer here. Lots is the answer. And it's, in my experience, it is not worth doing. When I have attempted it, it's meant looking at, bear with me 1 second, that is my phone going off. When I've looked at it, it's gone through not just the beginning balance. So all I did was calculate the difference on the beginning balance. If I go back to my senior debt sheet, it involves going through all the items, going through all your flows causing the balance to go up, flows going the balance to go down, and playing around with those different rates. It's possible. It just requires an awful lot of additional modeling to come up with that overall foreign exchange gain or loss. In my experience, it hasn't been worthwhile. Arup, thank you very much. I think we're now 4 minutes over, so let me bring the webinar to a close. I can see some people have had to leave already. So thank you very much for your kind attention on that webinar. If you want to find out more, if you're interested in our training courses, then please do drop us a line. info@f1f9.com is probably the best way to go, including if you want more information as a result of what you've heard on this webinar. We'd be very happy to help you if we can. Thank you very much for your kind attention, everybody, and we'll end the webinar now.